Welcome to Breaking News to Trading Moves. We're here to process the latest intelligence you sent us, zeroing in on the AI infrastructure ecosystem after a key report came out.
Yeah, today we're looking at Applied Digital, ticker APLD. Their recent results and their expansion plans are a pretty useful marker, helping us see where the capital expenditure is really flowing in this whole AI build-out.
Okay, so our mission is simple. Pull out the key facts about Applied Digital that got the market's attention, and then trace that out. Identify the companies analysts see as winners, and maybe those not keeping pace because of this AI acceleration theme.
Exactly. We're basically following the money, seeing how the demand for this really high-density AI hosting capacity is shifting priorities for data centers, power suppliers, server providers, the whole chain.
All right, let's get started with the catalyst itself then, APLD. What were the core numbers that moved the needle immediately?
Well, the top line was strong. Applied Digital reported revenue up 84% year over year, came in at $64.2 million, which, beat expectations.
Okay, an 84% jump, that's solid, but was that the whole story?
Not really. I mean, the beat was good, but the expansion plans they announced were probably more impactful for the stock move. Specifically, that new lease with CoreWeave.
Ah, yes, the 150 megawatt lease. That caught my eye, too.
Right. And that single deal, it bumps up their total long-term contracted value to roughly $11 billion. That's over 15 years.
Hold on, $11 billion over 15 years. That kind of locked-in revenue seems pretty substantial for a company like APLD. Why is that specific number, the long-term value, so important?
Well, think about it from a financing perspective. If you're going to build out large new data center campuses, say in North Dakota like they are, you need capital.
A lot of capital.
Exactly. And having a long-term multi-billion-dollar commitment from a major AI player like CoreWeave, that makes getting loans or project financing much, much easier. It shows a stable, predictable revenue stream, almost like a utility.
Okay, so that 150 megawatt deal isn't just filling current space, it's paving the way for future buildouts. It reinforces the acceleration, more power, more cooling needed, more racks.
And therefore, more orders for the companies supplying all that stuff. It also really highlights their strategic move, getting away from the volatility of crypto hosting towards these stable, long-term AI deals.
Makes sense. And that shift, validated by the CoreWeave contract, signals where the investment is going. And the stock reacted pretty strongly.
Oh, yeah. Shares spiked. I think it was around 16% initially, maybe pushed up towards 30% during the session.
Yeah.
A clear positive reaction.
All right, so that sets the stage. Now let's follow that money. When a company like APLD posts strong results and expansion, who else benefits? Let's talk winners, maybe grouping them by theme, starting with other owners and hosts.
Sounds good. So the basic idea for these companies, the hosts, is that demand for high-power, GPU-heavy colocation is just very strong. And customers are willing to sign long leases, like that CoreWeave example, which gives these hosts revenue visibility for years.
So besides APLD, the catalyst, who else fits in this bucket?
Well, a name that comes up is Digital Realty, ticker DLR. They're a much larger, more established player, right? Global footprint.
Right, a big REIT.
Exactly. And while APLD is more specialized, the sheer scale of AI demand means players like DLR also benefit. They're seeing demand fill up their existing high-density capacity, often at good pricing, because there's just so much need for powered space. Kind of a spillover effect.
Okay, that makes sense. So once the space is secured with APLD or DLR, the next link in the chain is managing the power and the heat, right? That brings us to our second group. Power and thermal infrastructure suppliers.
Yeah, and this is where things get interesting from a tech perspective. Your standard IT rack might pull, 10, maybe 15 kilowatts.
All right.
These AI racks, packed with GPUs, they can pull 50, 70, even 100 kilowatts per rack. It's a completely different ballgame.
Wow, that's a huge jump in density. So the old power and cooling systems just won't cut it.
Not even close. You need totally different infrastructure.
Which
is great news for the companies that provide it.
Like who?
Vertiv, VRT is a prime example. They specialize in thermal management and power gear for these high-density environments. Think sophisticated liquid cooling, specialized air handlers, robust UPS systems. All the stuff you need when racks get that hot and power hungry.
So their order books are likely looking pretty healthy.
Seems that way. And then on the electrical distribution side, you have Eaton, ticker ETN.
Okay, what's their role?
They provide the gear that gets the power from the grid safely and reliably to the rack. So switchgear, UPS systems, power distribution units, all the critical hardware needed to manage these huge power loads within the data center. As density goes up, their equipment becomes even more essential.
Got it. So hosts, power and thermal. That leads us to the final winner category, the actual AI compute and server ecosystem, the boxes that go on the racks.
Right. Can't have an AI data center without the AI chips and servers. And the leader there is, well, pretty obvious.
NVIDIA, NVDA.
Of course. Their momentum continues, driven by these massive orders for their GPUs to fill all this new capacity being built. Their market cap reflects that dominance. They're central to this whole build-out.
But it's not just the chips, right? It's how they're packaged and deployed.
Absolutely. And that's where a company like Supermicrocomputer, ticker SMCI, comes in. They're really levered to this rapid build-out because they specialize in putting together entire rack-scale AI server solutions optimized for GPUs, often with liquid cooling integrated.
So they deliver like a ready-to-go AI cluster.
Pretty much. They can deliver these integrated tested racks quickly, which is exactly what the hosts and hyperscalers need when they're bringing large amounts of capacity online fast. They seem to be capturing a good chunk of those volume orders.
Okay, that paints a clear picture for the winners. APLD, DLR, VRT, ETN, NVDA, SMCI. Now let's flip the coin. Where does the money seem to be rotating away from, relatively speaking? Who are the relative underperformers in this context?
Well, often when a theme like AI infrastructure gets hot and shows clear growth and contracted revenue, capital tends to move away from areas perceived as maybe more speculative or facing tougher competition. The first group that comes to mind are crypto miners, especially those who haven't made that pivot to AI hosting.
Why the pressure on them specifically?
It's about investor focus and perceived stability. You see the long-term predictable cash flows from AI leases like APLD's CoreWeave deal and compare that to the volatility of crypto prices and mining difficulty.
And the stability looks more attractive right now.
Often, yes. Plus, these miners are often competing for the exact same thing the AI hosts need. Large amounts of cheap power in specific locations. And right now, the AI build-out seems to be winning those battles for power resources.
So names like Marathon Digital, MERA, and Riot Platforms, ROT, might feel that sentiment shift.
Potentially, yes. If investors are choosing between the visible cash flow of AI hosting and the inherent volatility of pure-play crypto mining, the miners who haven't diversified could see less interest, relatively speaking.
Okay, category 1 is crypto miners. What's the second group feeling pressure?
That would be the legacy, or let's say more commodity server OEMs, the traditional server vendors.
We just talked about SMCI winning because they offer specialized integrated AI racks. So this is the flip side of that.
Exactly. The spending on servers is skewing heavily towards these optimized, high-density, often liquid-cooled platforms designed specifically for AI. That means companies selling more general-purpose servers face a tougher environment for these specific large AI deals.
The share of wallet is shifting.
Precisely. So companies like Dell Technologies, ticker DELL, might face challenges. While they have AI offerings, a large part of their business is still traditional enterprise servers, and the really big AI cluster deals often demand that highly integrated, specialized approach, where companies like SMCI might have an edge in speed or customization right now.
And Hewlett-Packard Enterprise, HPE, is in a similar boat.
Very similar dynamics. They're competing hard for AI deals too, of course, but they face the same challenge. The market for these massive AI build-outs currently favors those hyper-optimized, rapidly deployable rack-scale systems. It puts pressure on the product mix and margins for the more traditional players in these specific deals.
Makes sense. Okay, final group of relative underperformers.
This one's a bit more about budget allocation. It's the Edge and Content Delivery Network, or CDN, providers. Think companies focused on distributing compute and content closer to users, which is typically less power-dense than these core AI training centers.
Why would they underperform relative to the AI core build-out?
It's about priorities. Building these massive, power-hungry AI data centers is incredibly expensive. Corporations and cloud providers have budgets, and right now, building that core AI capacity seems to be priority number one.
So other projects, like expanding the edge, might get pushed back or scaled down.
That's the potential dynamic. If the focus is overwhelmingly on the core AI infrastructure, spending on edge deployments or CDN upgrades might be deferred. It's a relative game. The money has to come from somewhere.
Which names might feel this?
You could look at Cloudflare, TickerNet. If major enterprise or hyperscaler budgets are being heavily channeled into those core data center builds, maybe some planned edge expansion slows down temporarily.
And Akamai? ACAM?
Similar situation. Their CDN and edge services are crucial, but if the absolute top priority for capital expenditure is building out terawatts of AI training capacity, then other network optimizations might take a relative backseat in this specific spending cycle.
Okay, that covers the landscape pretty well. The APLD trigger, the winners across hosting, power, and servers, and the relative underperformers in crypto, legacy servers, and edge CDM. Looking ahead, what should we be watching?
Well, for you listening, one angle people are watching is the relative performance trade, pitting the AI power and thermal suppliers like Virtiv, VRT, and Eaton, ETN, against those legacy server OEMs like Dell, DL, and HPE. It kind of contrasts the infrastructure build-out versus the hardware competition within it.
And what are the key catalysts or data points to monitor?
Definitely keep an eye out for more lease announcements. Any other hosts or REITs announcing big megawatt deals for AI, especially pre-leased new campuses, would reinforce the trend. Also, watch for news about power. Updates on utility connections, power procurement deals in key areas like North Dakota, Texas, Virginia. That tells you about the real capacity coming online and the timelines.
All right, so based on everything we've discussed today around AI infrastructure, here's a question for you to think about. Which of those relative underperformers we talked about, the crypto miners, the legacy server OEMs, or the edge CDN providers, do you think is most likely to surprise us by landing a major AI-related contract or partnership next, potentially stabilizing their narrative? Something to consider.
And just before we wrap up, a quick note. Everything discussed here is based on the analysis and opinions of the author of the material we reviewed. It is absolutely not financial advice. Nothing here should be taken as a recommendation to buy or sell any security. It's purely for informational purposes, reflecting the author's viewpoint.